Now, the South African Reserve Bank, called SARB, released its October monetary policy review recently, and it confirmed that both global and domestic economic trends are likely to keep borrowing costs higher for longer, perhaps into the year 2024. Now, the SARB said that upside risks to inflation had strengthened over the past months, heightening uncertainty about a precise path for inflation. The rise in oil prices, dry weather conditions, and elevated inflation expectations were all negatively impacting the inflation outlook. However, the South African economy is forecast to grow by 0.7%, of course, in 2023, looking into 2024, due to stronger than expected investment and continued spending. So this morning, Professor Andrew Roux, development economist, is also economics professor at the Stellenbosch Business School, and he will be talking to us and helping us understand what the issue is with the South African economy. Professor Andrew Roux, it's nice to have you on the show.
Thank you very much, and good day to all your viewers.
Now, according to Statistics SA, South Africa's annual inflation accelerated to 5.4% in September from 4.8% in August, moving further within the central bank's target range of between 3 and 6%. So what's your take on the rate movement this year and, of course, the causal factors, having seen that it actually rose from a previous 4.7% in July?
Yes. Well, I think you will recall that the previous two Monetary Policy Committee meetings decided to leave rates unchanged. And the last one, we also know, however, that two of the committee members actually voted in favor of a small increase. And at the time, I think everyone was pointing out that inflation still has a number of upward risks, and we should not be too complacent and expect that the interest rates will necessarily remain unchanged during the course of the year. Since then, as you quite rightly pointed out, and this is the nature of the world, the nature of economics, things can change very quickly. Obviously, the oil price was already moving upwards. The crisis in the Middle East puts further upward pressure on the oil price. Food prices continue to accelerate in South Africa, roughly a 9% increase year on year, bearing in mind that the biggest victims of food price increases are the poorer members of society. We add to that electricity prices, electricity scarcities, wage increases are still generally above inflation, and very importantly, with a fairly still tight monetary policy stance amongst our major trade partners, it doesn't make all that much sense to relax interest rates here, because then you run the risk of our currency weakening even further, bringing with that even more inflationary pressures. And then finally, and I think I made this point last time we spoke, we're getting more and more messages about the fiscal situation, which had been in a difficult state in any case, actually aggravating in more recent times, which essentially implies we'll have to see. We have a very important budget speech coming up, the medium-term expenditure framework, early in November. We'll get more, obviously, information. But by all accounts, the budgeted deficit will be bigger than initially thought, which implies a faster growth in government debt than initially thought, which implies an even bigger interest burden, which implies higher long-term interest rates, which filters down to short-term interest rates. So all in all, the current feeling is that in the next Monetary Policy Committee meeting, don't be at all surprised if we see a 25 basis point increase in interest rates.
Yes, of course, we know that it was widely anticipated earlier in the year that the Monetary Policy Committee would retain the interest rate. And of course, it did decide to keep interest rates on hold instead of opting for a further increase of 25 basis points that you just mentioned. So looking at the inflation readings as at that time culminating to now, was that the most appropriate thing to do, as well as we know that it would affect our borrowing costs, businesses, and of course, consumer confidence?
Look, it's always easy to be wise after the event. I think at the time it was the right thing to do, but I think we must always read these reports very carefully and not just listen to the fundamental announcement, where it was made very clear, it's made clear every single time that words of caution are put forward. The governor in his speeches, etc., always tells us repeatedly, don't become complacent. We have not yet beaten inflation. Inflation is still very much part of the system. We were happy about it dropping below 5% a couple of months ago. It's now back to 5 point something percent. It's testing the upper end of the target range. And the general sort of approach is, and it's going to sound very harsh perhaps, is that inflation is more painful to poorer members of society than is high interest rates. That's not to say that high interest rates are not painful, but for the poorer members of society, inflation does far more economic damage, financial damage, and therefore it makes sense, although it might be painful, to try to bring inflation down as much as possible. In the long term, it does more good than harm.
Before now, the MPC had revised the gross domestic product growth forecast for 2023 upwards from 0.3% to 0.4%, while we understand that the growth outlook for 2024 remains at a very modest 1%. So if you consider these forecasts, Professor, in your opinion, what are the future possibilities here, and how key would it be, of course, for the MPC votes to take the right steps in addressing the country's inflation and, of course, improving its GDP?
Yeah. Well, you see, again, one has to look at and try to analyze the primary mandate of the Reserve Bank. And that says unequivocally that their main aim in life is to keep inflation under control. And they've got good reasons for saying that. As I just pointed out, when all is said and done in the longer term, it makes sense to try to keep inflation low. That will create the environment for longer term growth. I emphasize the word longer term. There's something else in mind. We have an exceptionally high unemployment rate. We all know that. But just think about this. If interest rates drop, then the opportunity cost for businesses to purchase equipment, machinery, actually drops. I'll repeat that. If the interest rates drop, capital equipment becomes cheaper, and that could be at the expense of labor. So almost perversely, an increase in interest rates actually makes capital machinery less attractive, and all things being equal, labor more attractive. So, we often have this view that lowering interest rates will create more jobs. It's not as simple as that. It's not guaranteed at all. Nor does better economic growth necessarily create jobs. You can grow an economy without employing any more people by becoming more capital intensive. The 0.7 growth estimated, I'm tempted to say 0.3, 0.7, 1.1 is just not good enough. It's not going to solve many problems at all. And the solutions to economic growth, if there are solutions, the recipe for better economic growth lies in so many areas. The obvious one is what we call load shedding here, electricity disruptions. As you pointed out in one of your opening news items, the fiscal has occurred there. We need a much better transport system. But even longer term, we need to reduce a whole bunch of deficits, which include government debt, household deficits, trust deficits, job deficits, and the like. We cannot sustain deficits for more than just a few years and expect the economy to grow. So there's no quick fix to our growth problems. It would make a difference in the short term if we could fix electricity and fix our transport logistics, but it won't elevate the growth rate to the much needed 5-6% of GDP growth per year.
Okay, now, of course, we understand that the SARB cannot resolve its problems, most especially as they lie outside its area of competence. For instance, you talk about the fiscal policy, energy challenges, or selling prices. Yet, these days, such factors feed into country risk and hence interest rates and, of course, the exchange rate. So, in what ways would you expect risks to be minimized?
You mean the risks? Well, I think, again, the fact that the Reserve Bank does what it does helps to improve the risk profile of the country. It neutralizes some other perhaps negative points. I think the mere fact that this country's central bank, Reserve Bank, is an autonomous institution and that it is led, I think, competently, more or less does the right thing at the right time in terms of what the markets perceive. I think it helps to enhance the profile of the country and helps to reduce the risk. Our Reserve Bank is often lauded by international commentators, the IMF and the like, as being a Reserve Bank, a central bank that does a pretty good job, albeit a sometimes unpopular job, but a pretty good job in the circumstances. Unlike a few other or democratic institutions of the country, it has retained through thick and thin its competence, its leadership ability, and, as I say, sticking to its constitutional mandate. Not everybody can say that. So I think, if anything, the Reserve Bank's action, as they do, enhance their profile. It's interesting that these foreign observers will often point out that the fact that we have a floating exchange rate, which from time to time, more often than not, tends to weaken, is actually a point in our favor. It acts as almost kind of an escape valve for other problems in the economy. That said, we must also bear in mind that many of the inflation-causing factors lie beyond the ambit of the control of the Reserve Bank. The Reserve Bank has no control over the international oil price or food prices or energy prices or obviously the fiscal situation. And yet it is held responsible for trying to reduce inflation. And they often get a lot of flack for that. But that's the nature of the thing. That's how these things work, unfortunately.
Earlier on, Professor, you talked about how inflation affects opportunity costs, which of course would affect consumer purchasing power and households, as the case is. So let's look at the worst case scenario. If the present inflation outlook in South Africa persists, what may be the next move by the MPC? You talked about the possibility of raising the rates to about 25 basis points. How far do you think that will go in reining in the issue of inflation and dealing with the foundational cause affecting the South African economy?
Yeah, well, excuse me, as I just said, interest rates can only go so far in addressing inflation via let's call it the monetary mechanisms, by trying to slow down the growth in demand for credit and the like. Interest rates have very little, any influence on the international oil price or international food prices. High interest rates can help to curb the weakening of our currency. That's a positive. But when all is said and done, there's always going to be a trade-off between too high interest rates versus the impact on economic growth. By the way, many countries are wrestling with this right now. The specter of stagflation, low economic growth, and high inflation, a very uncomfortable combination. Because as a policymaker, you can never win. If you're concerned about high inflation, you will tend to raise interest rates and thereby subdue economic growth. If, on the other hand, you're concerned about economic growth, you might decide to lower interest rates, but end up with even higher rates of inflation. So I think it's more about prevention is better than cure. Rather, use interest rates now to curb inflationary pressures than have to really substantially, aggressively raise interest rates 2 years down the road. That said, most of the forecasts, both international and local, do suggest that in the next couple of years, inflation will average at below the upper end of the target rate, unless something totally unexpected, untoward were to happen, which of course you can never eliminate. But given our current knowledge and appreciation of future trends, inflation should manage to drop below or stay below 6%. I had a quick look a couple of days ago. As recently as July last year, the inflation was 7.8%. It's now down to, well, 5.4%. That's quite a big difference, quite a meaningful difference. Also, perhaps a positive point is that this month, October, the petrol price here went up substantially by almost 2 rand. By all accounts, early in November, it will drop again by perhaps as much as 1.50 rand. That will provide some relief, at least there, in terms of the effect of fuel price on inflation.
And talking about dealing with issue of fiscal deficit, earlier on you said the government will need to plug the gaps. That's paraphrasing what you said now. So how feasible do you think that will be when we see the rise in the rate of inflation and, of course, the cost of procurement also skyrocketing and the need to deal with government expenditure? How feasible do you think that will be?
Yeah, well, you see, this is where economics and politics become entangled. Obviously, in this country, sometime next year, we have a general election. The ruling party obviously would like to gain a majority and win that election without having to go into coalitions. So one cannot see on the fiscal side dramatic cuts in spending. one of the reasons for fairly high levels of government spending are the civil servant wage bill, which is equivalent to close to 15% of the GDP. But also, very importantly, various kinds of social grants. 20 million plus South Africans benefit from a monthly grant from government. Now, some of these were supposed to be temporary in the wake of COVID-19, but they've been extended once again till at least next year. And as I say, I can't see those grants being removed or reduced on the eve of an election. So, as I say, politics, ideology gets entangled with economics, unfortunately, in most countries, which is essentially saying that government spending, I don't think we can see that dropping. Tax revenue collection, well, that is curbed to some extent by a very low economic growth rate. It means the tax base is hardly getting any bigger. It means in real terms, tax collection might actually be somewhat smaller. What is left then is that large and growing government deficit. That's where the concern lies. Financing that, it'll cost us a lot. We obviously have to offer fairly high rates of interest in our government bonds to entice people to buy our bonds. That further elevates the government debt burden, which further elevates pressure down the road in terms of allocations for other forms of spending. So the next few weeks, months, I think we have to accept the fact, rightly or wrongly, that fiscal decisions will in some way be swayed by non-economic realities. At the same time, the finance minister and his predecessor have said repeatedly, they realize the problems we are facing. They realize we simply cannot afford in any manner of means an expansionary fiscal policy. It's about a more contractionary fiscal policy without hurting the livelihoods of millions and millions of people. Just one final point, and that is what's also crucial, is that the mix of government spending needs to be restructured. Far too much of government spending is allocated towards current spending. Not enough is allocated towards capital spending, which is a real source of economic growth. Yeah. Over time, that will have to shift dramatically if we want to talk about a structural change in the economy.
Yes, and now talking about government spending and the revenues that should come in and the areas that these funds will need to be plugged. We know that the MPC members will be meeting in November, and we should also be expecting the South Africa's medium-term budget by November also. So what input are you actually expecting to see documented in the budget to actually ensure stability in the economy, boost confidence, and promote the growth of course, the South African economy?
Well, I think they're going to try very hard in the medium-term expenditure framework, which is a 3-year kind of view, to emphasize their commitment to fiscal discipline. Once again, I would imagine, and always controversially, they'll make noises regarding the civil servant wage bill, trying to at least freeze that or prevent it from growing, which will again create political volatility. But they'll make that point. They will point out, no doubt, that X trillion rand over the next 3 years will be devoted towards investment spending, which is what we're looking for. But all of this is only as good as the assumptions made regarding things such as economic growth prospects for the next couple of years, only as good as the tax collection capacity of SARS, South African Revenue Services. It's also subject to assumptions that have been made about the global economy. Where's that going? Even there, we're not quite sure. Assumptions regarding, once again, the oil price and conflict in the Middle East, conflict Russia, Ukraine. There's growing tension, so it seems, between China and their allies and the so-called Western countries. All of that will have a bearing. So as I say, anything said in the budget speech, the medium-term budget speech, will be as good as possible to say, given our assumptions or their assumptions made regarding a whole range of variables, some of which are beyond our control. Then, obviously, not long after that, we will have the Monetary Policy Committee meeting. And as I said earlier, I suspect that given the weight of evidence that will be confirmed in the budget speech, namely high budget deficits, along with points I mentioned earlier, high food prices, energy prices, etc., I suspect there's a pretty good chance that the next MPC will announce a small increase in the repo rate, a 25 basis point increase. If they were tempted to do so a few weeks ago, when the inflation rate was less than 5%, I'm sure they'll be even more tempted to do so this time round.
Okay, even as we drive this conversation home, Professor, let me quickly get your reaction on this. Now, the South African rand strengthened against the dollar on October 17, 2023, according to reports ahead of closely watched local inflation figures, which could offer investors clues on the central bank's potential rate path at its next policy meeting next month that we all are actually anticipating. Now, is there anything there that investors can hold on to as hope for a more rewarding investment climate?
There's so many moving parts here. In economics, we always say all other things being equal. I think that investors generally internationally are risk averse, understandably so, in this world of polycrises. And I'm not sure that South Africa offers the best possible investment climate amongst a whole range of developing countries. The history of the rand exchange rate so far this century has been one of extreme volatility. And I don't think 1 or 2 days really tell us the full story about where the rand is heading. As always, and as unfortunately, we also know the rand's value is often influenced by non-economic factors, politics, ideology, perspectives, perceptions, rumors, scandal mongering, and the like, not always by pure economic variables.
Professor Andrew Roux, development economist and economics professor, Stellenbosch Business School. Thank you so much for your profound contribution.
Thank you.